When people put money into an FD, their usual expectation is somewhere around 5 to 7.5 or 5 to 8% returns and very low risk. But what if I told you that there is an asset class and an investment opportunity with lower risk than an FD but also higher returns? Then that is what we are going to discuss in this video. It's everything that you need to know about GILT funds. So inside the video, we'll discuss everything that you need to know about what are GILT funds in detail, how do they work, what are the advantages, what are the disadvantages, and what is the secret benefit that traders have from them. Welcome to another video by MarketFeed. This is Ajay Ajith. Let's get started. So what are these GILT funds? GILT funds are nothing but mutual funds in India which invest into GILT securities. So what are these GILT securities? When the central government or the state government wants to raise funds for infrastructure development or any of their budgetary needs, they tend to issue bonds, right? And with these bonds, they raise money, and these bonds always have a coupon rate, they have a fixed price, and they also have a tenure. So I hope you already know about the basics of bonds. A bond is nothing but a borrowing that the government is doing, right? It is borrowing from whoever is buying that bond, and with a promise that this amount, entire amount, along with its interest, will be paid back. And because this is being done by the governments, right? These GILT securities are extremely safe. The government cannot go bankrupt, right? And the government, they'll end up printing more and more money so that these bonds always have a very high safety rating. So whenever the government wants to raise funds, the government will issue bonds. These bonds will have a fixed price, they'll have a fixed tenure, they'll have a coupon rate as well. So we'll get into the nuances later. But when the government issues these bonds, these mutual funds can go ahead and buy these bonds, and we can go ahead and buy the mutual funds so that we can also enjoy the benefits of the government bond with very, very low investment amount. So what are the advantages of going ahead and buying these government securities, or specifically these GILT funds, right? The first thing is that they have very low risk. It is backed by the government. We already discussed that. The second thing is that they tend to generate more returns than FDs over a longer period of time. We'll get to that, and we'll get to why it works also. And the third thing is that it is generally more safe than an FD, because in India, if you're going for an FD, it has an insurance value of 5 lakh rupees. That means any amount that you put into an FD, up to 5 lakh rupees will be insured in case a bank collapses. But above and over that, it will not be covered. That means if you put an amount of 10 lakh rupees into an FD and unfortunately the bank fails, you will not be getting the entire 10 lakh rupees as insured. You'll be getting only 5 lakh rupees. But in the case of government securities, this will not happen. The government will make sure that you get your amount back. The next advantage is that there are no early redemption fees. So in the case of an FD, in case you want to exit or break the FD before the tenure, you always end up either taking a penalty or taking a lower interest than what was promised. But in the case of these GILT funds, you get what you see, right? In case you see a 5% return, that is what you get. You can withdraw the entire amount and it will be reflected into your bank account. There are no early redemption charges in the case of these funds. And the next advantage is, right now it looks like a good time to invest into GILT funds. GILT funds usually tend to work best in an environment where the interest rates are going down. So let's take this example and we'll quickly explain this, right? So let's imagine that the government of India is issuing a GSEC or a government security for 10 lakh rupees at a coupon rate of 6% for 10 years, and that is trading, or that has a fair value of 10 lakh rupees. Now let's imagine 1 year later the interest rates go down and they issue a new bond for 10 lakh rupees with just 5% returns. What do you think will happen to the old bond? So both these bonds are very similar, except for the fact that the older one is giving you higher interest. So naturally, the price of the older bond, the demand for the older bond will start going up. So in India and across the world, interest rate cuts are expected over the next 6 to 12 months. So again, this could be a right time to invest, or at least look into this investment opportunity that are GILT funds. The next disadvantage is that gilt funds are extremely liquid. You can enter and exit anytime that you want. This mutual fund will be automatically buying and selling GSECs or government securities on your behalf. But in fact, if you're going to buy GSECs on your own, it will be very difficult. The process itself is not that difficult, but transacting the secondary market, the volumes on the secondary market, everything will be too complex generally, right? So these gilt funds offer an opportunity for the average investor to make sure that they can start investing directly into government securities. So it all sounds so great. You can even get more than double-digit returns when the interest rates are going down, and you can expect a returns of 6 to 8% in a normal year. But what is a catch here? What are the disadvantages or the cons? That's what we're going to discuss in this section. The first con I would say is investment tenure, because generally if you want to pass through an entire interest rate cycle, you have to stay invested for more than 3 years, at least 3 to 5 years. So in this case, if you want to enjoy the real benefits of a gilt fund or the real returns, you'll have to stay or get invested for at least this time frame. Right? That is the first catch here. Then there is also a second catch, which is interest rate risk. So as I told you earlier, these government securities, they have a tendency to increase and decrease in price. Right? It is a highly volatile asset. When I said safe earlier, it is in terms to the risk. The bond is always assured by the government of India, but there will always be the interest rate risk. So in the earlier example, we saw the interest rate reducing from 6% to 5%, and our bond prices increasing, and hence the mutual fund price also increasing. But what if in a scenario the interest rates start increasing? Then what happens to your older bond here? Your older bond's value will start going down, and you will see a temporary, a short-term hit in your capital as well while you're investing into gilt funds. So it is always not a smooth journey like you'll see in FDs. There is one risk which is called as the interest rate risk that you should know about. So I would say it's a very interesting investment opportunity, especially because these are backed by the governments, right? And they are extremely risk-free. Now let's look at who should invest and how much should you invest. When we're looking into who should invest, the general thing that I would want to say to you is that if you're a high net worth individual, if you have a lot of money, or if you're trying to reduce your risk exposure, you should definitely look into gilt funds. Someone who is just starting their investment journey but are willing to take a bit more risk, they can directly look at the equity market or even balance funds where they deal with both equity and debt together. The third category of people who should look into this are traders. So traders have an added benefit that whenever you go and try to pledge your GSEC or your gilt fund, it is always treated as a cash component. That means the broker treats it very similar to cash. You'll be getting a high pledge value. Also, the margin that you get from these investments or these pledge assets, they'll be treated as cash components. That means you can easily take positional F&O trades with this money. I've done a detailed video on how pledging works, what are cash components, what are non-cash components, what are haircuts, everything that traders need to know, and I'll attach it here in the I button. Make sure you go watch it if you're interested. With regards to how much should you be investing, if you're a long-term investor, you know that 80-20 rule where it says 80% into equity and 20% into debt is a generally good framework. So in that framework, this 20% into debt, you can consider investing it into gilt funds as well. And for traders who are taking mostly positional trades, up to 40% of your capital can be deployed into gilt funds for rather safe returns and pledge benefits also. So now we'll quickly look into what all are the biggest gilt funds that are available in the market. So the biggest one right now is the SBI Magnum Gilt Fund. It has been giving decent returns over the last multiple years. The fund managers look very promising and they have the highest AUM among gilt mutual funds. So the second one here would be ICICI Prudential's Gilt Fund. There is also a third option which is Kotak Gilt Fund. So these are all the three gilt funds which are coming directly into the mutual fund category. Now for added benefit, there are two ETFs also that I'll talk to you here about. So ETFs are nothing but exchange traded funds. You can imagine them as mutual funds itself, but which can be transacted using a broker's account. There is the SBI's 10-year gilt ETF. There is also a Nippon India's ETF as well. I'll show both the ticker codes here on the screen. So yes, hope you all understood about an amazing asset class that you should be definitely looking into, which are government securities and the attached mutual funds to them, which are called as GILT mutual funds. So that is everything that we wanted to discuss in this video. See you again next time. This is Ajay Ajith signing off. Bye bye.